Okay, welcome everyone. Today is Wednesday, March 16th. Welcome to this live intraday strategy webinar on SB Trade Desk, and welcome to FOMC Wednesday. Guys, we just got the release of the CPI figures for the US, largely in line with expectations, slightly stronger on the core read, as we were looking at in yesterday's piece. Core read coming in expecting 0.2%, came in at 0.3. More importantly, the headline figure, core year on year, 2.2 coming up at 2.3%. You saw a quick climb in the dollar index. Still looks constructive, guys, to start off the session. Looking at resistance, a little bit more important resistance, 12,087, a basic 38.2, but more importantly, that median line off the highs. So do note that that data came out stronger than expected. Again, building permits weaker than expected. Got a little bit of a mixed picture, excuse me, on the housing starts. Also stronger than expected there. So building permits dropping off, housing starts picking up. Decent numbers on CPI. We got industrial production at 9:15, just a couple of about 45 minutes from now, and capacity utilization. I wouldn't put too much emphasis on this. This is a strong number by all means. The core CPI number that the Fed has been targeting, 2.2% climbing to 2.3, is certainly a positive for the Fed's ability, to be able to move on with the normalization process. So that being said, welcome again to everyone here in the room. Doug, Eileen, Gary, got the whole crew here today. I was chatting up with Joe earlier saying that he had some nice scalps on the Kiwi dollar. He says knowing the levels ahead of time makes scalping much easier. Waiting for key areas is priceless. And again, Joe, cheers, mate. I mean, that's our goal here. And certainly that's the whole name of the game, is knowing your levels ahead of hand. All you got to decide is the triggers for the entry and exits. Gary, we'll definitely take a look at dollar yen. We're taking a look at all the dollar crosses today, guys. So if you have any dollar cross questions, feel free to throw them on the message board. We're going to go through them one by one. And Gary, definitely 100% gold. We can't definitely forego that on a day like today. All right, so let's jump right into the juicy stuff. Fed comes up at 2 o'clock. You got the subsequent presser with Janet Yellen. Quick reminder that the midweek strategy webinar with Jamie will be held tomorrow in light of today's FOMC decision, so we can clear out some of that volatility ahead of hand. All right, so looking right at the economic docket again, keep in mind that industrial production number, we'll try to cover that if we can, if we have time, at 9:15. But really, it's the headline figure will be the FOMC interest rate decision at 2 o'clock and subsequent presser. Quick performance of the U.S. dollar here ahead of the U.S. Open. You can see that the dollar is stronger against all its major counterparts. The biggest loser on the session is still the British pound. Okay, obviously we didn't see any major changes to the UK from the BOE earlier today. Some commentary there. Wage growth bonuses accelerate 2.2. That was some data that came out. Nothing that's really catching the attention as far as anything that the BOE said. So we'll continue to watch that. More importantly, the FOMC interest rate decision. So let's jump into the dollar crosses. Before we do, here's what the WRP looks like, the Fed futures funds rate ahead of the release. We highlighted this earlier in the week. I just wanted to point out that you're getting a build, okay, in the latter part of the year, specifically the second and third quarters. You're starting to see those percentage or the probability of a hike start to mount. If you look at it today, here's what the Fed futures funds rates look like right now. You can see that they're building up even more, okay? If you look at September, November, you're starting to see those climbs into the 70s and 60 percentages. And as we get through the session, based on today's projections from the Fed as it pertains to growth, inflation, unemployment, we're going to see how that moves the needle with expectations here on higher rates from the Fed. And that's really what's going to be the major driving factor for the dollar crosses today, guys. So we want to make sure that we're being very mindful of it. We'll give you an update on this. I'll tweet it out shortly after the release to see where we've moved, if we have moved at all. So now that we got a quick recap here of what we're looking for heading into the dollar or heading into the release today, here's what the dollar index looked like yesterday. And let's cover dollar price action here before we move forward. So we noted on Friday, or on Sunday rather, on the open that we were looking for some early support in the week. You got the rebound off of confluence support, 50% retracement. You got that long dated former channel resistance acting as support. All right, and that's sort of still the focus, major key support that you need to note for the dollar. On the upside, as we noted yesterday, initial targets were at the 200-day moving average. We've already taken that out. Secondary targets and the bullish, or the bearish rather, invalidation level, key resistance, is still 12,087. It's a basic 38 too, but more importantly, you can see those swing lows from December. You could see those highs that we made for September, and you can see the median line coming off that high from December, all confluencing right here. Here's what it looks like. Here's what it looks like on the wrong chart, on the 30-minute chart. And here's what we look like now. All right, so yesterday we were looking for that topside break, which was favored. You were testing channel resistance, a move above 12,040, which was just simple swing low. Takes us into the 200-day moving average. That's already been achieved. And there's that key 12,087 level. Looking for a possible spike into that region. Let me snap these levels for you. Looking for a possible spike into that region on FOMC. So let's just take a minute here and kind of just go through what we're expecting or what we should be looking for on the FOMC with regards to price. So the dollar index has made a pretty radical and sharp reversal. Excuse me, guys. I'm sorry. I'm losing my losing my voice, and the fun hasn't even started yet. By the way, the Bloomberg Terminal Funds Futures and Releases screenshots with your highlights on the update page is a great idea, very helpful. Eileen, if that's the case, I'm going to keep it up. It's definitely something I look at. I try not to throw too much background information in the scalp reports because I want you guys focusing on price. And a lot of times once I get into the fundies, we start to look at that. You start to take your eye off the ball. But by all means, Eileen, if it's something you guys are finding helpful, we're here to serve. Make sure that you got all the information you need. With regards to the dollar index, where we are right now, my sort of thought process moving into this is this. If the release comes out and you get a really strong negative dollar movement on the onset of it, I would be looking, prior to tagging this, I would be looking for the pullback to offer some support and a final rally back into that region. Okay? If the initial reaction is a surge in price, and you see price climb right into this region, any hesitation up here would be an indication for me to fade that move. Okay, so just to put it out there on what the expectations are from my personal standpoint of how I'd be looking to scalp this. The dollar has already made a surmountable rally off the low. We're looking at major key confluence resistance near term. If we kind of get a jackknife to the downside on the release, I would be looking for a final stretch into this region. If the release prompts just a straight up dollar rally, I wouldn't touch it. I'd be looking for a rally into this region, again, to offer some near term short triggers. The one thing that you want to keep in mind is this: the broader trade turns constructive if we clear the yearly open. Okay, in 2016 open comes in right there at 12,131. So to put things sort of in perspective, this region right here, you have the 100-day moving average just above it. This is the 50% retracement of the entire yearly range. It would necessitate a break above former basic trendline support, turned resistance, and the yearly open. Okay, not to mention that April high day close from last year as well. So you have a lot to look at right up there. The levels are very, very clean, and this is how we're going to continue to play it. So on FOMC, again, if we get a spike into this region, I'll be looking for short exposure. If you get a pullback, the broader trade still remains constructive while above this region, so you do need to be mindful of that key support, and that longer dated slope could offer a little bit more of a substantiated rebound more than what we've gotten. So certainly on a pullback scenario, if we haven't tagged this, I'd be looking for possible long exposure. So where does that put us on the majors? Before I move off, any questions on the dollar index, near term, long term, from where we are right now? Okay, there's a quick picture sort of side by side where the index stands. Okay. If there are no other questions, we're going to jump right through the report. I'm going to leave the euro crosses and the sterling cross for last. We've gone over those a couple times this week. There was not really much changes. Euro dollar, I'm really not a fan of where we are right now. I would love to see a little bit more of a substantiated pullback to get on the long side. But just from where we are right now, I don't necessarily see an outlet for us. But dollar CAD, being a little sneaker here, might be up to something mischievous. So let's take a quick look at what the dollar CAD is doing. Okay, so dollar CAD yesterday looked like this, and basically, if we're going to make the assumption that we've made some sort of low in price, um, the validation of that breakout won't happen until we get above 34.60. So while I do like the idea of the long side for the dollar CAD, I do like the reversal concept from here. You made a 786 retracement of the October advance. You have the 200-day moving average. We have closed below it, but yesterday was a very definitive close back above. Momentum, you've been getting some divergence here into those new lows. So price action making a lower low, the oscillator making a higher low. Breaking back above 40 could be a signal that we're turning in momentum, but you haven't really gotten the validation yet. So what are we looking at? We're looking for a near-term resistance at the former high day close. This is the high day close from September of last year. A definitive pivot in price. Certainly the longer dated 618 retracement. This is off the decline, dating all the way back to the highs that we made in keep going. 2001, I think it is. 2002. Okay, so this is a long dated retracement. You can see the 618 coming in right there. You had a really nice pivot and inflection point on that last year. And that's now acting as near-term resistance alongside that September high day close. All right, so basic channel resistance looks like is giving out now as well. This is channel resistance just off the yearly high. And we'll be looking for that possible move into this region to clear the way for a much more substantiated reversal here in dollar CAD. First target would be on a breakout. You do have that 100-day moving average, which has offered some really nice pivots in price as well. Okay, support, resistance pivot. That comes in line right around that 136.71 region. Here's what dollar CAD looks like on the 30-minute, and this is what's a little bit more interesting, at least for me. Here's what we looked like yesterday. We were butting right up against that trendline resistance or channel resistance. Here's what we looked like last night. Initial near-term targets, aside from that 200-day moving average, is still a little bit higher from where we are right now, guys. You have 34, what is that, 34.19? 34.19 is simply the high day close, again, like I said, from that September run. And then that 34.61 is going to be that long-dated 618 retracement. Okay, so your initial targets are on tap. The bigger level, a basic 236 off the high takes you into 35.25. And one other thing I just wanted to note is a different slope. Okay, so this is the basic channel resistance or trendline resistance we were looking at on the daily chart. That's what you're looking at right here. But there is a different slope embedded within this that has resistance just higher. And that's this one right here. Okay, so you got 1 point, 2 point, that converges right on a basic 236 of the decline, right around that 32.25 level, 32.26. So the levels are pretty clear. And again, that's sort of what would validate for me a much more larger scale reversal in dollar CAD. If we do get the break, your inherent sort of longer term objective on this move would be a basic test of key channel support. You have 1, 2, 3 tags of support, break, simple rally back into the yearly open at 38.11, back into former channel support. Maybe a basic move here would be looking for dollar CAD. Okay, that being said, if this fails here at 34.60, we get some short triggers, or the FOMC charges a rally right into this region, which fails, might be a nice area of possible short exposure. A question here from Eileen says, for dollar CAD, you're waiting for more pullback now to go long again. The current long trigger earlier on this morning. So dollar CAD, I'm not looking to do anything here yet, Eileen. I don't want to try to fight I'm not trying to call lows on it. But from what we're looking at price action, if the assumption is to be made that we made a low, I would need to see a break of those levels, a pullback, and then get long. That being said, like I said, if we spike into this on FOMC and it fails miserably, I'd be looking for a rally to sell back down. It really, for me, this is just an FOMC play. I don't have anything. I'm not going to touch this thing ahead of the release today. especially dollar CAD with where we are right now, because there's so much interest to continue pressing the long, and the trade has continued just to dwindle lower. So for me, I want either validation of this breakout on a pullback scenario, trying to get long here for a tag of that yearly open, or if FOMC charges a rally that fails through that resistance and it moves off, I'd be looking for a near-term rally again to take against that high, looking to play the downside. Does that make sense? Eileen says, okay, makes sense. Perfect. So sort of the same, remember what we said earlier in the session, guys. Everything that we're looking at with the dollar index, translate that into the dollar crosses. Okay, it really depends what the initial reaction is to the FOMC. I also want to note this: the projections will be telling. And as we put out in yesterday's piece, just a quick reminder, guys, what we'll be looking for today is that dot plot. I put a link for you here for that Sunday report where we highlighted the dot plot that everyone will be focusing on. Okay, this is your sweet spot right here. If we see the median and mean estimates start to move down, that will be an indication that market expectations are pushing out, or specifically if this moves down, that means the committee is showing expectations that, you know what, we're unlikely to be able to move rates quite as aggressively as, we wanted to. Just some background information. I was having some discussions with some of the guys here on the trade desk in New York and some other friends of mine at some banks here in New York, and the discussion is getting out of control with what the expectations are for today. You have the camp that's saying, look, the Fed may be able to raise rates even more so now. Why? Well, you have easing out of Japan. You have extended easing out of Europe. You have easing out of some of the other European countries outside the Euro, Sweden, Switzerland. So these guys are negative rates, right? That's basically global easing on their part. It makes it easier. It makes the global environment more accommodative, and it allows them the room to begin to normalize. I'm on the opposite side of that camp. I'm on the side of, look, if they're going to really look to move rates right now, that is really driving the divergence in monetary policy even more. That's going to do a couple of things. A, it's going to really prompt some further dollar appreciation, which is not going to be good for the domestic recovery. And B, it's going to make global conditions much more difficult when you have central banks across the globe that are all heading in opposite directions, right? One's on the race to the bottom into negative rates, and here we are trying to hike rates. And I think that divergence in policy outlook is going to really hamper the Fed's ability to be able to normalize. Just my humble opinion, just to give you guys a picture of what the discussions are going on amid the community here on how this could pan out. But the basis and the major thing people will be looking at today is going to be the distribution of this dot plot and any changes that we see here. I'll tweet this out, the new dot plot, as soon as it's released. Always remember, you can go to the Fed's website, federalreserve.gov, to obtain this as soon as it's released as well. But the presser subsequent to the release is really where you get most of the volatility, and it's usually because of an off-cuff comment or someone presses Yellen on a specific topic and she says something unexpected. So keep your ears peeled for that presser. I'm sure there's going to be a lot of questions with regards to the topic we just discussed, on account of how are you looking to move on rates when the central bank policies around the globe are really going in complete opposite directions. Eileen says, smart opinion. Yeah, we'll find out, Eileen. We'll find out today. Could be completely wrong. But that's why we don't let the fundies lead, right? We're watching price action, and that's what's going to be key. All right. Any other questions on the dollar CAD before we move off? Again, 36.10, that 618 long dated retracement, that's going to be the break we need to validate a much more prominent and substantiated turn in dollar CAD. Moving right along, got to keep up on time here. So dollar Swiss, a trade that we were all over last week, posted that massive outside day reversal off of key resistance, and we've been looking lower ever since. Here's what dollar Swiss looks like now. So a slight adjustment to our pitchfork from last week. If you note, last week we were working with the same pitchfork, but we were working with it off the highs, like this. Okay, if we do a quick adjustment to that high that we made on the 18th, you can see that it actually caught the spike high on that day almost to the pip, It also completed an exact 618 extension off the low, former trendline support, now resistance, all resided right up there just above parity 62, parity 63. The move to the downside, completing a 618 retracement. You're seeing a little bit of a rebound here. It's been an extremely tight range to start the week. Here's what it looks like on the 30-minute chart. And again, just to zoom this out a little bit, there's that 618 retracement just off the lows, that major outside reversal day, and here's the rebound. If we get the charge and the break to the upside, remember, dollar strength, right? Hey, Minho, great to see you. Cheers, Eileen. I appreciate the comments. If we get the break to the upside, which is what I would expect to see, you're looking for resistance near, or resistance targets near 99.46. More importantly, right here at 99.80. Okay, you have the 200-day moving average, or the 100-day moving average, excuse me, and a basic 618 retracement of that decline off last week's high. Okay, an area of which, if we get into, again, I'd start to look for some short exposure as we came into the upper median line parallel. On a scenario where you see a jam or sort of a jackknife to the downside on the Fed, especially if the rates or if the expectations move higher and you get the opposite reaction, might be a beautiful opportunity to get long. On face value, guys, for the Swissy, it's simply a weekly opening range. That's all I'm doing. Okay, your weekly opening range low is right here, 98.14. Weekly opening range high is right around 98.95, let's call it. And we'll be looking for a definitive break. If this gives out ahead of the Fed release, again, all bets are off, guys. You get this type of market lull ahead of these releases that sometimes can really prompt some wrong price action. A lot of times you'll get some back and forth, back and fill, and it might trick you out a little bit. Okay, I'm just trying to deter you from getting too excited ahead of the release because you will get some extreme volatility specifically on the dollar pairs. So game plan for dollar Swiss is if we get that jackknife and you see a hold into the weekly opening range low, I would love to try another long position from here. If we don't get an opportunity to get long and you see that stretch up towards 99.80, I'd start to look for some short exposure near 99.80, and specifically that key 618 that we ran into for the last 2 weeks at parity 28. Any questions on the dollar Swiss? And I have to say a couple of things. The momentum signature looks pretty constructive. You spent most of the majority of the week thus far above the 50 threshold with multiple breaks above 60. That's not something that I necessarily want to fight. So I'm looking for the rebound. Again, the general play is if you see a stronger upside rebound towards that 0028 level, that 618 retracement, the yearly open, I'd be looking for, again, short exposure near that region. Right, Eileen, 100%. And be careful with chasing strategies, guys. Patience is key. Absolutely. Absolutely. Especially on a day like today. Look, if you don't get well, let me take a step back. When the release comes out, you're going to see a surge in volatility. If you're not already in a position, you don't want to do anything on that surge. You want that surge to allow you to get better positioning on an entry. If the surge is to the upside, like I said, wait for the pullback to see if we can get that stretch into that 618. If the surge is to the downside, initially, I'd be looking for some basing near the weekly opening range low for some possible long exposure. By the way, just as a disclaimer, this is the bullish invalidation level by all means at this point. It's just a simple weekly opening range low and a nice pivot in price. All right, so let's move right along. That is dollar Swiss. Next up on tap from yesterday was the Aussie dollar. I highlighted this one actually on Daily FX as well after our webinar here yesterday. Remember that we're looking for downside on the Aussie after the major, I wouldn't want to say major, but after the reversal that we made off the highs. That 75.90 level in Aussie was a pretty big region. We talked about this yesterday briefly. That 75.90 level actually turns out being the April low day close. Let me move that tag here so I don't have to look for it next time. The April low day close, which was that low that we made, or the close low that we made on this, what is this, a 5-month spout on which we sat on that as support, 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 support before finally breaking in early July. That key level and the low day close for April is the exact high that we made. 75.90 was the exact level. The high was exactly 75.93. Okay, so the pullback, we're looking to play that pullback with a little bit more fervor. I do think you possibly see a rebound here on confluence support. This is just a simple 50 line dividing the upper quadrant here of the median line off the yearly lows. And it's also a basic 236 retracement. That's 74 handle. And as we noted in yesterday's piece, that was sort of the first initial target that we were looking for on the downside, and you got it. Here's what the intraday chart looked like yesterday. I know it's really messy, guys, but it's been a messy setup. And here's what it looks like on the near term. Here's what the live chart looks like for now. Okay, so you saw a break of that 74.45 support, 74.42 support in overnight. Actually, that happened more so just ahead of the open of U.S. futures markets here. And the downside move just pips away now from our near-term target at that 74 handle, 74.08, 74.11. And again, don't forget that sliding parallel, that 50 line comes in right there as well. Okay, so for FOMC, the game plan, especially if we hold support here, I would look for a rebound. Specifically, near term, the major resistance you want to look at is still going to be that 74.83, 74.85 level. If we break through here, you'd likely see a run right back onto the weekly open and again onto that key resistance. Remember, the broader trade is still constructive for the Aussie. We are just looking to play a more prominent near-term correction. So on its face, as it stands right now, I would be looking for FOMC to offer me a rebound so I can try to take a short again, looking for a break inevitably of that low. Okay, and remember again, here's the broader picture is extremely important here for Aussie. On a downside break of here, there's really nothing of magnitude until you head into about 73.80. 73.80 is going to be those highs that you made in December and October, if you look to the left of the chart there. Okay, so October was exactly 75.80 was the high, 75.81. In December, the high was 75.84. Okay, so that's going to be your first target on the downside. Beyond that, you're looking for this level right here, which is the December high day close. So very clear-cut targets on a downside break. We are coming in some near-term confluence support. On a rebound, we'll be looking to use that rebound to get back on the short side. Ultimately, we're just looking for a drop to get back on the long for Aussie dollar. Any questions on the Aus? Again, a quick reminder for anyone who's new to the room, we got a big crowd here today, guys. That camera button in the top right-hand corner of your GoToWebinar screen, go ahead and use it at your leisure. Anytime you need to take a freeze frame of any of these charts, go ahead and click on that so you can refer or reference them whenever you want throughout the course of the day. So that's the Aussie. One other comment I just want to make, Aussie's not out of the woods after today. You still get those Aussie employment numbers tomorrow. And specifically on the back of what we've been seeing with the Aussie employment numbers, could be a big play. Could be a big play. Remember, we went over it yesterday in the webinar at length. They've seen a massive contraction in full-time employment, with most of the job gains that we've been seeing coming via part-time. And this dynamic is certainly not something that's encouraging to the labor markets in Australia. So we'll be continuing to track that. And again, those numbers hit tomorrow night. All right, that's Aussie. A quick recap on dollar yen. The abomination certainly looks poised for a move. I don't really, I'm not really a fan of dollar yen, but certainly as we head into these types of event risks, dollar yen can be very, very, very volatile, and certainly is a very strong reactor in general to broader U.S. data. So a couple things to note. Looks like we have a trigger right there I'm going to want to watch. A couple of things to know. I know this chart is extremely messy, guys, but just bear with me. The only thing I wanted to highlight here is a couple of things. First, that broader, longer-term median line, I know we've sailed through it many, many times, but we've still continued to pivot off that same slope. Okay, the median line, the slider, been offering some really nice pivots on the upper median line parallel when you broke through, offered exact support, and the break offer an exact run. And this is what you want to see to validate that you're not just looking at some, foreign slope, that the slope actually has merit. And when you see a break, you want to see that run. When you see a breach, you want to see that rally. Okay. Again, here we breached the upper median line parallel again. Look how far that rally extended. On the downside break of that same upper median line parallel, look how far it ran to the downside. Here's that same median line of the same slope tracking the highs all month long. Okay, key levels to clear for dollar yen on a breakout play. 113.97 is going to be that 236 basic retracement. More importantly, the weekly opening range high comes in just above that. And that's the break that would really be needed to validate a much more substantiated rally. 114.40 is going to be a nice target you'd be looking for. That was last week's high, is an 88.6 retracement from the decline off of that February 15th high, or this downside move here. And heading deeper into the session is going to coincide very nicely with a median line here, right around 114.40. Any questions on dollar yen? Again, I know it's an ugly chart, guys, but it's an ugly pair too, so we'll take it for what it's got. I know that the swing side of trades, by the way, as a disclaimer, you guys are still holding that long entry from 113.40. Stop is still at 112.05. If you're holding those long positions, again, you're really banking on a move through 114.40. I think that would open up the sort of spigot here to see, or I guess spigot would be the downside. It would open up a much more substantiated rally to the upside. But your first key region of resistance is going to be those highs from last week, that 88.6, really nice pivot in price, that median line, all coincide right here. Any questions on dollar yen before we move off? Expect some volatility here for sure. Tends to move very strong with US yields. And that is dollar yen. All right, let's jump into euro. We'll touch on sterling, and then we'll jump into some of the commodity blocks. And I also just want to take a recap on Aussie yen. Has been making some progress through after breaking that initial weekly opening range low. First up, euro dollar. So here's my buddy, the euro. And again, I love, I want to see this trade really give us a little bit more conviction. I would have liked to see that spike into those, after that subsequent rally we made on the 10th, give us a little bit more downside. Didn't really quite get it. Loved where we bottomed out on that move. Remember, the yearly open, 108.72, was a big region. You also had the median line for the current operative structure right there. We based there to start off the month. We tried to crash through it, couldn't do it. And here we are with the break to the upside. So I'm still favoring a move towards 112.50, 112.63. You have a lot up here. 618. This is the 618 retracement of the decline off of the highs that you made in October. This is the 100% extension of the ascent off the lows. This is the 764 retracement, or excuse me, that is the 618 retracement of the entire decline off of the August highs. This is a 764 from just the October highs. And add to all that over the next few days, specifically heading into next week, you're going to start to face that upper median line parallel that caught that rally last month. So I do think you see a final stretch into that region. Where do we go from here? Here's how it looks like on the 30-minute chart. So it's been an ugly weekly opening range. Here's your weekly open. You kind of spiked back into that 618. It failed. You're not really holding this median line formation we've been looking at, so I'm not going to really stress this formation at this point. One thing you might want to add here is just a sliding parallel. Just want to see if this actually caught it. Could be. Kind of just leave it there for now. But I don't really have a play for us, which is what I was saying earlier in the session, guys. I don't really think that this is poised for anything just yet. If you put a gun to my head, if euro spikes lower back towards 109.64, the lower median line parallel, I would be looking for long exposure. On the flip side, if this thing just completely rockets, dollar sells off on FOMC and it spikes into this region, be looking for possible short exposure from here. But broadly speaking, I'd like a pullback to get me back, to get me the ability to get back on the long side. Keep in mind, 110.45 is loosely, I want to say, what I'm working with as the bullish invalidation level. So as long as we hold above that, I'm favoring the long side. What's so special about 110.45? Not much, except for the fact that it's a simple 618 extension off the low. Confluence dead on with the 200-day moving average in green. You can see that sliding in right there. And if this is the objective weekly, monthly opening range, so if the monthly open is in March right here, this is your opening range low, we tested it again here on the 10th, that would make this the opening range high, which again comes in just above that 110.45 level. So keep that in mind. I mean, that's kind of the thought process I'm looking for. If we get a spike into this 110.45 and see some hesitation, maybe that'll charge the rally into the highs. If you see a break below 110.45, well, then expect that drop way down into the lower median line parallel. All right. I wish I had some more conviction for you on the euro, guys, but largely speaking, I would expect to see some dollar strength push this lower, but I'd like to use that drop, as it were, to see if we can get some long exposure. If 110.45 gives out, look for that lower median line parallel to offer some support. And that, my friends, is euro dollar. Just a quick word on euro Aussie. Especially with our expected downside bias on the Aussie dollar, if Aussie does continue to lose some steam here and euro does find some base, whether it's at 110.45 or 109.30, whether it's on either of those levels, Aussie weakness might propel this higher. Okay, and the one thing I'm looking at is, first of all, the yearly open. We're checking that as resistance as we speak. That comes in basically at 149.12, 149.13. The major resistance region I just wanted to highlight, guys, is right here. Confluence resistance region, right around 150.74, 150.75. It's going to be the spike high that we made last week. 618 retracement of the advance off the December low. More importantly, the operative median line for the formation that we've been following off of this year's highs. So this is sort of the breakout zone that I would need to validate that we've put in a major low here for Euro Aus, and I'd love to play those topside targets. First off, looking for the 200-day moving average, 152.41, and then up into the 153 handle where, again, you have some more prominent confluence. So another possible play here, much wider range ATR than what we're looking at with the Euro. So you're looking at 215 pips, 214 pips on a daily basis. So again, roughly speaking, you're looking for about 50 pips per scalp. Here's what it looks like on the intraday chart. Again, just to highlight that 50.74 region, guys. Feel free to take a snapshot on this if you need it. I don't think I've posted this on the site quite as recently. So if you do want to take that view there, feel free to take that snapshot now, guys. And again, when that break, if we do get it, here are sort of the key levels. I'd be looking for. Questions on Euro Aus? All right, now to our friend, the British pound. Here's what sterling looks like on the back of BOE and ahead of FOMC. Sterling, dollar, made a break below the bullish invalidation level that we were looking at earlier in the week. You had a basic channel support that we were looking at. If you remember, if we recall rather, the radar charts from earlier. Here's what we looked like yesterday. We went over this chart, and we were looking for that 42.05, 42.14 level to offer some support, and that was going to be the bullish invalidation level. If we broke below that, sayonara. initial targets at 41.34 and 40.63. You're just above that target right now. You almost exactly touched it and kissed it in overnight trade. Here's what sterling looks like on the 30-minute. So quick zoom out. Okay, and in comparison with where we were, came right into that support. Again, validation, and what you want to see in your analysis, guys, when you highlight a confluence area of resistance, you want to see the market react, just like we did here, right? Just like we did here. As the market came into this on Friday, it was a big confluence region, just straight, trend lines, nothing even fancy. You saw a real mean reversion trade into the close of the week on Friday. Here we are heading into major key support. Again, the bounce should have been a much more substantiated bounce if we were going to get it, but that we got the break, complete and utter breakdown. Okay, on a move like this, the only opportunity to get long would be on this rebound here to try to take a stop against that high to continue to play to the downside. So there's that subsequent target at 40.63. We just touched it. I do have a soft target pivot at 140.30. That's just simply a pivot in price that we've been following. But more importantly, if we zoom out, the lower median line parallel is what the last saving grace is on this trade. And let me just bring up also the 786 retracement here. So that confluence there with the 786 comes in at 139.63. Doesn't really coincide with that lower median line parallel until later in the week, but just below it, watch that slope line. Okay, with specifically that we've seen so many reactions and nice pivots off of that slope, we're going to want to pay attention to that 39.63, and that's going to be the broader bullish invalidation level. If that gives out, guys, the whole idea or concept of sterling having made a low last month is going to be out the window. Okay, keep in mind also that the low day close comes in at 139.10. And I have that marked for you right here. All right, so broadly looking for a spike lower in the sterling for some basing here as we head into the FOMC. Kind of makes sense with a possible dollar rally, a surge into that key resistance on the index that we went over earlier in the session. So the puzzle piece is fitting together quite nicely here. And we'll see if pound can find some sort of support here heading into FOMC. A question here says, for sterling dollar, would you have taken that break of confluence, or would you be better have waited for the later rebound before shorting with the throwovers, etc.? I missed that, but wondering. Yeah, on this break right here, I'm not going to lie to you, Eileen, I probably wouldn't have touched it. It was a pretty severe break, and it happened pretty quick. The only position that I would have been interested in was on this spike high to try to take that short trigger against 142, 142.05, 142.06, that 38.2 confluence that we were talking about. Would have been the best play for that, in my humble opinion. But taking a break here, just trying to short this on this move, not something that's pure chasing, right? We don't want to do that. So if you miss the break, or if you're not holding a trade into the break, you wait for that rebound to try to offer you a better entry to the downside. Now, ATR has been rather wide here, despite the fact that we're not really seeing all those big swings. Just the fact that this thing has been a slow dribble has kept the daily ATR, a quarter of it, up to 38 pips, which is very nice for a scalp candidate. But Eileen, to answer your question bluntly, yeah, I wouldn't have touched it on the breakdown. If anything, this is where the entry would have been. Also note when it happened. Okay, the high was made at 9 o'clock, at the 9 o'clock hour. So that means the opening range for the US peaked at the highs. And on a break like this, when the session opening range peaks, that's sort of where you want to trade against. So it would have been an easy trigger for me, in my mind, to take a stop just against the US opening range high, which is what that was. Sterling has sure been giving chase scenarios. Absolutely. It's what it does best. The most professionally traded market, guys. Never underestimate the pound. And I'm not saying that it's a dollar yen type of trade by any means, but it's very widely traded by the professional.
Industrial production in U.S. fell 0.5% in February. That says
Okay, there's the industrial production numbers, guys. Just hit the wires right now. Came in at 0.5, negative 0.5, missing the mark. Also, keep in mind that we got a downward revision for the previous month from 0.9 to 0.8. So, largely speaking, a disappointment on industrial production. Capacity utilization, also much weaker than expected, dropping from 77.1 to 76.7. Manufacturing production, slight uptick here. Quick look back at the dollar index. Oh, okay, looks like we're going to get that pop. Watch that 12,087 mark coming right up, 38.2. Again, the confluence resistance with that longer dated median line formation we've been following. Certainly interesting position. Now, if we head into, I want to just take a step back here, guys. If we head into the FOMC and the dollar index is at resistance, it provides a little bit different of a ball game. Okay, I would still be looking for a possible spike through to get short. For me, the only interest I'd be on getting on the long side if we're here is, a break through the yearly open. So a scenario where dollar index is trading at 12,087 ahead of the release for me makes things a much trickier trade, guys. So just keep that in mind. But certainly looks like we're on the right course here, looking for that rally towards 1287. All right, so we went over British pound. I do want to cover some of the commodities. I saw some questions here earlier. Was that you? Gary wanted to look at gold. Yes, Gary wants to look at gold, dollar, yen. So Gary, let me know if you have any other questions on dollar, yen. We went over that earlier. Here's what gold looks like. All right, it's a messy trade. I don't like the daily chart. The intraday chart looks interesting. The weekly chart looks interesting. The daily chart, not so much. Here's Gary says I'm all sorted out on the abomination. Cheers, Gary. Here's what I'd be looking at with gold, man. The 30-minute or the 2-hour chart rather has been a little bit more telling. So if you guys recall, we were following this on the intraday page for a few weeks now. You saw the break of that consolidation really fizzle out rather quickly on a quick 100% extension of the range of the consolidation. So again, typically when you look for these consolidation breaks, you take the range of the widest part of the range of the consolidation, and certainly the 100% extension basically caught the highs here. Now the break to the downside, interestingly enough, look where it's pivoting on resistance. Former resistance, caught support, now is capping the advance over the last day and a half. Okay, as we sit on the 618 retracement of the range. So for me, this is going to be a play on FOMC. No way of cutting it any other way. If you see the dollar struggle near that key resistance that we're looking at, I would be looking for some basing near in gold. But if the dollar breaks through 12,087, you're likely to see the gold correction give you some more downside. To give you a broader picture of where gold is, here's the weekly chart, and this is what's more telling for me near term. Okay, a couple things that I'm looking at is this. A, that trendline resistance, basic trendline resistance off the swing high that you made in 2013, specifically the August high. Resistance. Yeah, we peaked through it, but the close was very brief. We only had one weekly close just barely above it before we came off. All right. The other thing I'd be looking at is this. On those last few highs that you made, specifically in price, I should have left that line chart up, but you can see higher high in price, capped highs in the momentum signature right at 70. That's divergence, right? All you're looking for, remember, in divergence is that the oscillator is not reflecting a new extreme in price, which is what you got on this last spike. So that suggests, yeah, you might be in for a little bit more of a substantiated pullback. So for me, I'm not really interested in trying to short gold. If you get a much more substantiated pullback towards that median line right there, I'd be looking to buy on a pullback. But as it stands right now, as a play for the FOMC, I kind of just want to let the noise settle, sort of get some of this noise out of the way before we start to move. If anything, just to clean this up real quick. If anything, I'd be looking for something like this. Maybe over the next 2 days or so, a drop near 1193 would be a basic 38.2. More importantly, just below that, you have that swing high that you made from October of last year and the median line coming off the lows. So sort of an area of which I would start to look for some dollar support. Remember, this is a weekly chart, guys, much more longer term. But certainly the implications for today's FOMC interest rate decision are going to be strictly on what the dollar does. A question here says, well, shoot, should have sold that last gold bullion piece when I had the chance. I wouldn't worry about it, Eileen. I do not think, let me just take a step back, guys. I don't think that the gold sell-off is necessarily something that you're going to want to hold as a constant bias moving forward. I know that everyone's been bearish gold. Everyone and their mother has been bearish gold for the last couple of years, and rightfully so. Okay, you're looking for Fed normalization. Higher rates on the dollar will tend to weigh on gold, which does not pay a dividend. But that being said, you're seeing a shift in dynamics right now with the markets, in that we came into the year extremely confident. Okay, extremely confident that we were going to get 4 interest rate hikes from the Fed. Look where gold was trading at the start of the year. You got some of those developments. You got some, upset volatility over in the risk markets with some easing measures, additional pledges to ease even further overseas. And then you start to get some weak U.S. data. And as those Fed futures funds rates got kicked out, look what happened to gold. Okay. More importantly, we've been talking about this, the broader shift you've been seeing in the momentum signature. And I think this is even more evident for gold on the daily chart. Guys, this is the first break we've seen in overbought territory for gold, literally, since 2012. Okay? And it's the highest spout of overbought condition since the peak that we made, the record all-time highs in 2011. Okay? And remember that throughout the course of 2015 specifically, this thing really struggled to hold above 60 in momentum. Here's a 60 failure, 40 break, 60 failure, 30 break, 60 failure. Now you're starting to hold 40. 60 failure, a last tag, but on that last tag, what happened? Some strong divergence, price action making a lower low, the oscillator making a higher low. So on the daily chart, you're starting to get that momentum shift. Now here's your most monumentous break above 60 and your highest read since the peaks we made in 2011. That's a broader shift in the momentum profile, the behavior of the momentum signature. So Eileen, I say all this to say, as your joke is saying here, that bullion piece you have, you might be able to sell it at a better price later in the year. But as it stands right now, yes, the risk is for a little bit more of a drawdown in gold. I would be treating this gold move to the downside as a correction, and I do think ultimately we do see a test of that 1293 level, the high week close for 2015. If not, the 2014 high week close, which takes you into a little bit more of a critical resistance confluence. All right. That's cool. Thanks for the hope. You're more than welcome. More than well. And again, I'm not trying to sell you on hope, Eileen. I'm just telling you what the technicals and what the price action is telling to us right now, and what kind of things we want to be paying attention to. All right. Quick look. And Gary, I hope that helps on gold. Let me know if you have specific questions on the gold trade for today. But honestly, I'd be watching the dollar index and I'd be watching interest rate expectations. That's really what's going to shift stuff the most. If you get a really hawkish Fed, which I don't necessarily foresee, but let's say they come out saying things are looking good, we're going to be looking to normalize as planned, see dot plots move up for some insane reason, look for gold to come under pressure, 100%. Guys, it's all about the chase for yield. Okay, if I can put my money in a U.S. savings account and it's going to pay me 0.75%, or I see that interest rate expectation is forthcoming, there's no point in me spending money on gold, which I have to pay for storage and does not pay a dividend. So just keep that in focus from an investor standpoint, like what we're looking at. All covered. Many thanks, Mike. You're more than welcome, Gary. A quick look at crude. Well, we can't forego that either. Here's what the crude chart looks like heading into the FOMC today. You saw a nice clean rebound right off the 100-day moving average. We talked about this yesterday. It was the initial target, sort of on a move below basic trendline support. You got a nice little rebound there. Look, you're still at risk sub 38.11. Key support is still 35.47. 35.34, 35.53. This region right here. As I said yesterday, I wouldn't put it past this thing to see a test of former upper median line parallel resistance turn support before we move back up to the upside. But either way you look at it, any way you slice it, that 38, 31, 30, 47 level, still critical resistance. If you guys remember, we actually looked at this level way before price even approached here. We looked on this level on the break above that 35.30 level, and it's been holding for over a week now. Okay, this is going to be entering the third week of which we find resistance in that region. What would be sort of the sayonara trade, the lookout below trade for crude? Very simple. Break sub, the median line parallel, the upper median line parallel, which we should offer some support, and a move of this downside trigger to the in momentum signature here would suggest in my eyes that the broader continuation would be on hand for a low here in crude. Any questions on oil? Okay, and one quick note I just want to touch on, as I noted earlier, the Aussie Yen Trade. This is something that we've been following from last week, and even earlier this week, it was on the radar charts. Here's what Aussie Yen looked like earlier in the week, and I just kind of wanted to touch on where this thing has progressed to. So if you remember, we talked about major key resistance near term near 86.32, 86.31. You had the 618 retracement of the decline off of the December high. You had the median line itself coming off the lows that we've been following. Well, you got that pullback. Initial support and the near-term bullish invalidation level was the 2015 low day close, specifically that August drop-off that we saw, and that was 84.72. Well, we've moved well below that. We tried to break back through it today and failed. Here's what the intraday chart looks like for Aussie Yen. Okay. Again, there's that 84.72 level, the low day close from last year. Downside break saw the 38.2 find some support. We tried to make it through there and failed again as momentum, failed at 60 from a sub 30 read. Still looking lower here in Aussie Yen. So another trade again. If you're getting involved in Aussie Dollar, another trade you can look at if you want to try to avoid broader dollar exposure would be this Aussie Yen. The only thing that would shift the focus back to the upside, guys, would need to be a break above 85.47. Now, ultimately, we are looking to buy Aussie Yen. That's important to note. Ultimately, if we do get a move back towards former basic trendline resistance, that multi-week consolidation high that we were working off of. I don't want to stress this 618, but I do want to stress this 618. Or I guess at this point, the 50 is going to give us a better line. Bear with me one sec here, guys. Let's check this out. It's right there anyway. 82, basically the 82 handle. Do something like this. All right. So just a quick update there on Aussie Yen. I do think this is going to be an interesting play that I want to follow, and tends to be a very risk-sensitive pair. Both on account of the Aussie's correlation with broader commodity markets and the yen's very, very tight correlation to just in general U.S. event risk. So take a look at Aussie Yen as we get through the release today as well. My voice is struggling, so if there are no other questions, we're going to go ahead and wrap it up here. It promises to be a very eventful day. Guys, we'll try to keep you as updated as possible on SB Squawk. If you have any last-minute questions or pairs that you want to cover, feel free to post them on the message board now. Again, we're just about a minute outside the open of U.S. trade. And again, 2 o'clock gets the release. About 2:30 is when the presser will start. I will link and give you an update on SB Squawk again once those dot plots come out to kind of give a picture of where we are or how much of a big deviation we saw from the last quarterly projections that we got from Fed members. Best of luck trading here today, guys. We'll be back on board tomorrow morning at 8:30 to cover the aftermath of today's events. And again, quick reminder that Jamie's midweek strategy webinar will be tomorrow at 2 p.m. or at 1 p.m. Eastern. Till then, best of luck trading. We'll see you tomorrow morning. Cheers.